Nothing in this podcast is intended as investment advice, and the people in this podcast may hold positions in the stocks they talk about. Do not buy any investment based solely on a tip or recommendation. Please do your own research.
Hello and welcome to the festive midweek takeaway. Today we're joined by Carl Esprey, CEO of Contango Holdings. Welcome, Carl. How are you today?
Very good, Phil. How are you?
Yeah, very good, thanks. So 2021 has certainly been a highly active year for Contango, having successfully acquired two high-value gold assets in Mali, whilst continuing to advance the Lubu Coke coal project in Zimbabwe. These have significantly, strengthened the company's portfolio as it looks to transition into a cash-generative mining group in 2022. Can you tell us more about what 2022 holds for Contango, please?
Yes, of course. I think you're right there. We've done two acquisitions this year. One last year. These are near-term cash flow assets that we know quite well, and certainly in the coal assets where millions has been spent understanding the underlying asset, and that allows us to just rapidly advance towards production. So 2022 on the coal project, we'll see production very early on in 2022. We already are sinking the shaft. We already have yellow metal coming onto site as we speak, and obviously then, as we said in the previous press release, we'll move quickly towards producing a coking coal battery. So we'll start producing coke in 2022. We can speak a little bit about the coke dynamics and the coking coal price as well as the coke price later, if you prefer. On the gold asset, we got quite a surprise. I think you might recall we bought what we thought was a small, scrappy gold asset, and we were going to put it into production quite quickly. Further analysis showed that we might have something much larger than we thought, and we've had a lot of work done on it. We've even had regional gold players come to our site and confirm some of the work that we've done. So I think 2022 will give us some options on the gold asset. Either we can spend money advancing the project, or we could look to do some sort of strategic tie-up with someone who could advance the project for us. Obviously, that would mean us reducing our stake in the asset. But I mean, that's quite common in this space.
Do you want to talk us through some about the prospects of the Lubu coking project?
Yeah, I mean, the prospects for coking coal at the moment are extremely healthy. And that's largely because, as is quite widely reported, coal is a dirty word these days.
Yeah.
But what gets mixed up there really is that there's multiple types of coal and lots of uses of coal. Really three major categories. One is coal for power, thermal coal, which obviously puts carbon into the atmosphere, and no one wants that anymore. But there's also coal for industrial use. Coal is a chemical, and it's used to make all sorts of other chemicals. And lastly, the big category is coal for production of steel and ferroalloys within the smelting process. And in that process, at this point, there's no technology to replace coking coal. Coking coal is turned into coke. Coke is put in the blast furnace with iron ore in the case of steel, and that's what makes steel. And so when they shut down a coal mine, because largely coal mines around the world are a blend between coking coal and thermal, there's very few coal mines that are just pure met coal, and very few coal mines that are pure thermal coal. So as people are shutting down coal mines, they're shutting down production of both coking coal and thermal coal. So they're throwing the good coal out with the bad coal, I guess, if you want to think of it like that. And you've seen a huge resulting spike in the price of coking coal, because the steel producers still need coking coal, regardless of what the view is of thermal coal. They still need coking coal, and they're getting quite desperate.
Yeah.
So we've seen coking coal prices and coke prices rise dramatically, and that's obviously been very beneficial to us. I mean, we can't claim credit for it, obviously, but it's nice that our project is positioned well within those dynamics.
And recently you raised, $2.5 million to take that project into full production. Can you give us some idea of when that project could potentially become cash generative?
We've already commenced the construction of the project. And as we said, we raised £2.5 million. We already had £1 million, so we had £3.5 million in total. The coal mine, the construction has started now. That'll take about 3 months. The coke, and obviously then we're producing coking coal, which we can sell. So that'll be cash generative within 3 or 4 months. Coke battery, we'll start off with a small modular coke battery, which will produce around 3,000 tons of coke a month. And I mean, the market dynamics for coke these days, it sells for about $700 a ton, and the margins are more than 50%. So even at $3,000 a ton, we'll be producing multiple millions of EBITDA per year, which will be used then to expand into a larger coke battery. Yeah. So what we want to do is get into production and then use the cash generation from that production and organically.
One thing about the size of this project, looking at it, is just how vast it is. I mean, well, huge, vast, whatever superlative you want to kind of throw at it.
Yeah, that's right. I mean,
tons of coal. I mean, this is a project that could literally run for centuries.
Correct. And then, and I think at some point Zimbabwe said they will continue to invest in thermal coal, and at some point thermal coal demand in Zimbabwe will require some of our coal as well, and that could we've left that as a blue sky scenario. We've really concentrated on the met coal on the project, because obviously we don't want to be producing thermal coal unless there is a dedicated power plant to take our coal. But I'm quite confident in the next, but I mean, this isn't going to be years, this is going to be a decade. There'll be a thermal coal plant to take our coal as well. And even then we'll have centuries of coal, because this is such a big coal basin.
Just explain to the listeners, what you're talking about is taking the raw coal out of the ground, obviously the met coal, and you're going to be changing that into coke.
That's right. We take coal out the ground, we wash it to get into the specs that we need. So
Okay.
They literally stick it through a washing machine. I mean, but it's obviously a big coal with centrifuges, and it washes the coal and separates some of the dirt from the coal. We then stick that into a coke battery, which compacts coal and heats it for about 24 hours. It's actually burning, very hot. Then it pushes it. I mean, the coke machine looks quite amazing, actually. I can send you a video at some point.
Yeah, please.
But that then takes the coking coal and turns it into coke, which is kind of a more spongy. It's a product that has all the carbon, but it also it's hard enough to allow iron ore to sit on top of it. And then we sell that to a client who puts that into a blast furnace, puts iron ore on top of it, heats it, and the combination of the heat and the carbon will extract the iron from the iron ore.
Okay, so from the process of the raw coal to the coke that comes out as the final product. I almost want to say Pepsi there, but that's just a funny joke. The coke that comes out as final product, what percentage, so you put 100% of raw coal in, what percentage comes out as coke in the end?
Yeah, so you put in 100 tons of coal into the wash plant, 50 tons will come out. Yeah. So you lose half in the washing. Mm-hmm. Then you put in 50 tons, you need 1.6 tons of coal to make a ton of coke. So then of the 50, you're getting 30 out as... You're
getting 32 coke out if it's 1.6.
Yes, correct. You're getting 32 out of coke. So for your 100 tons that you dig out the ground, you get 32 tons of coke.
Okay, so it's like...
The cost base is around $120 a ton at the site.
Yes.
And coke sells in China or Brazil for $600 to $700.
So you're getting 32 tons of coke, let's say, for the sake of argument, at $600 a ton. So you're getting 600 times 32, which is what, about 18,000?
Yeah, I mean but we just used 100 tons going in as an example.
Yeah, no, I'm just giving the analogy of how much it's going to cost. So basically, if it's 3 times, it's like 360 input, 600 output, as you say. So yeah, so it's 100% markup on basically what's coming out of the ground. The question that I was posing when I was reading all the RNSs and trying to get involved in what you guys were doing is the big deal here has got to be a good offtake agreement. So is this likely?
Let me put it this way: if we were selling coking coal only, then it all comes down to the offtake agreement. And there's lots of coke producers in Zimbabwe now from China that will buy our coking coal, but because they basically, there's 4 big ones, and I mean very big. In the one case, they do 200,000 tons of coke a year, and they're expanding to 1.4 million tons of coke a year. So that's huge. I mean, that's Chinese scale. So they all manage the price of coking coal locally to a very low level because they are the only buyers of coking coal that goes into coke. That's why we're going to go the route of building our own coke batteries. So we aren't beholden to them. Once you have coke, the market for coke is very broad and very easy to sell. There's lots of demand up in the DRC and northern Zambia for the ferroalloys industry. There's demand in South Africa. South Africa currently imports coke from Australia. And coking coal, actually, even though South Africa exports a lot of coking coal, it imports a lot of good coking coal from Australia. And then, as I said, within Brazil and China, there's a lot of demand for coke. So with coke, getting an offtake is very easy. Even getting an offtake from one of the trading companies would be very easy. So we just need to now get to a point where we are not only stuck selling coking coal to a group of 4 Chinese coke producers in Zimbabwe, because then we'll have a margin, but the margin won't be what we want it to be.
What sort of production level would you like to have in terms of coke coming out per month?
We're going to start off with a containerized, and it's not a container as in what's on a shipping, but it's these small containers of coke. We've started the pre-ordering on a containerized coke battery, which produces 36,000 tons of coke a year. Using that does about 3,000 tons a month, and the margins are about $300 on that. So you're looking at about almost $1 million a month of margin. A full module of a proper container, or a proper coke battery like the Chinese run in Zimbabwe, is about $12 million. So using the cash flow from that coke, we will then start the process of building a full module, and that does about 150,000 tons of coke a year, so just over 10,000 a month. Plus we'll have the 3, so then we'll be sitting at about 15,000 a month. And then from that, we can expand, just like they've done elsewhere in Zimbabwe. The Chinese producers of coke in Zimbabwe, none of them have a coal mine. So we do have one advantage over them, which is that we're fully integrated. And we, as long as there's demand for coke, we could just expand, adding 150,000 tons of coke capacity for $12 million a ton.
That sounds like a very profitable business. I mean, basically doing the sums there, that's $54 million of EBITDA. So by the time, what sort of time scale are you on for the 15,000 tons?
The first module we're doing is this containerized solution that does 3,000 a month. So that'll be 32,000 a year. And we've started ordering that now. So realistically, that's 6 to 9 months from now.
Okay.
And the coal mine will be ready before that. So there'll be a period where we're selling coke and coal only. And then as we start ramping up our coke production, you'll start to see our EBITDA margin really shoot up. And then the cash flow from that will be pumped right back into a larger coke battery, which would, I would guess, take another year after the first one. So we'll be through a continual organic expansion process.
So end of 2023, I know we're talking a long way in the distance in terms of the way people think about their investments sometimes, but end of 2023, you can see yourself with the ability then to have the $54 million per year, which would be the 2 plants. Yes, we'll be either finished construction or right by the end of construction of the second coke battery. Yeah, and one of the things I suggested, which might or might not be true, was that all of this cash flow that's going to be kicked off could also mean that you don't need a joint venture for the gold mine. You can go and do it yourself. Yes, I guess. I mean, that might mean we delay some of the work then, because obviously we're going to be a lot of the coal cash has been dedicated towards coal for the next 2 years. Building gold mines is more expensive than this. So I hear you, but we just have to manage that we don't want a period of 12 months where we do nothing on the gold either, because then the government in Mali starts getting twitchy. Okay. Yeah, I mean, it was only my suggestion. I'm not telling you that that's the thing to do. So what is the next step with the gold mine then? I mean, the gold mine, we are preparing for drilling. So we've done aeromagnetic work, we've done IP work, and all of that's been interpreted by our geological team. And from that, they've pulled out a series of targets that they are confident that, well, they are A, confident are targets, and B, want to drill to understand what's under the ground more. So in the next few weeks, we'll commence the drilling on site, and then we'll announce those results to the market. Post the drilling, we'll have a really good understanding of what we have. And also we'll have data that we can share with some of the strategics in the area and see what proposals we can come up with. And as you said, if the proposals aren't really attractive, then we'll continue doing things ourselves. And if they are attractive, then we'll look to see if we can execute on some of those.
And you're targeting up to sort of 2 million ounces on an NI 43-101 resource.
Yes.
Do you have any ideas of any kind of historical grades or any widths or anything from these previous
projects? The whole region, and I mean, there's obviously the larger Mali, but within the region, the grades are 2 to 3 grams a ton. I don't see any reason why we would be any different. But if you look at Barrick's mining gold up in Lulo I think they're doing underground gold now at 0.5 gram a ton. So 2 to 3 grams a ton is very profitable in the Mali context, because it's these huge open pit disseminated resources. Whereas the South African stuff, where you need the high grams a ton, it's because they have 3 kilometers underground chasing very thin seams. So not to oversell it, obviously, but what the geologist said to us is that 1.8 million ounces was just on the one target on Garalo. But you recall we bought the neighboring deposit. And obviously, I think if we get the 1.8 million on that target in Garalo, we'll get much more than 2 million ounces, because we still have an entire deposit next door, which we've seen the extension go into.
Yeah, and are these two projects, I know they're adjacent, but are they contiguous?
Yes.
Okay.
And that the reason we bought the one next door is because our geologists saw the strike length continue into the deposit next door.
So when is it likely that you will have some drilling results for the gold?
We'll commence drilling probably middle of January. So I'm guessing that the results will come in March. They'll have to do drilling. It has to get sent away to the lab. It needs to get interpreted late February, middle March.
Is that diamond drilling or is that percussion drilling?
No, it's all rad drilling. We might do some diamond holes later.
Yeah.
But in the beginning, it's going to be rad drilling.
Okay, so what is the immediate, or is there any immediate catalysts for Contango in the next number of weeks or months?
Well, what people will see now is on our Twitter feed, lots of photos of us under construction. They'll start to see real activity on the ground in Zimbabwe. Obviously, we can send photos of people drilling in Mali. I'm not so sure, but we'll do that for updates, but that's not as sexy as lots of kit arriving and holes being dug in Zimbabwe. And I think that starts to, in people's minds, crystallize the fact that there is a mine being built. As we've always said from the beginning, this is not a lifestyle company. It's been set up that way. This is one of the lowest paid executive teams in the whole of the stock market. So we need activity. We need to either move into cash flow quick, and we need appreciation on the share price, or else this has all been, totally not worth it for management. So I think you'll see over the next few months and weeks, the starting of construction and the finishing of construction of the coal mine. Hopefully, that's a good catalyst.
Yes, indeed. So how are you all skin in the game then in terms of that? If you're low paid, how much
we shareholders and we have options.
Okay, at what level? What sort of percentage do the board of directors have in Contango?
12%.
Okay.
And obviously then there's an option package, which is equates to roughly about 10% of the company. And that's all been done at the IPO price.
Okay, which was
5p.
But the money you raised recently was at 6, no?
Yes.
I know you're not allowed necessarily to give forward-looking statements, but where do you see yourself Christmas next year?
I see EBITDA running in Zimbabwe at about $1 million a month. So what's about 12 million a year. I see us understanding, at least having a resource statement on the gold in Mali. We won't have a gold. I don't think we'll have a gold mine. Depending on what the drill results come out with in Mali, I think we'll have a resource statement and we'll have currency. We'll be able to do a deal on our gold, or at least we'll be able to talk to shareholders about how we do it ourselves. So we'll have much more understanding on the gold with a nice resource. And we'll be doing, as I said, $1 million a month in Zimbabwe and starting the expansion to something that will produce 4 or 5 times that a month.
Okay, so what would you suggest with the sort of 250 million shares plus when we talk about the warrants as well? What sort of share price are we going to be looking at with $1 million EBITDA coming in?
Well, I guess it all comes down to multiple, doesn't it? I mean, it's a growing business, so that would lend itself to a premium multiple. One can say, but it's a mining business.
In this market, you can't say anything.
Yeah, correct, exactly. But it's a mining business, so you can take the premium away. I don't know what is on EBITDA 5 times, 6 times. I'm not sure what.
I mean, basically, as it stands at the minute, if the share price was the same as it was today, then you're not far off producing the same EBITDA as your market cap.
Yes, correct.
So let's say coal mining. We've done the calculations before with a PE of 4 or 5, just to be very conservative.
It's a 5 bagger, 4 or 5 bagger,
and that's without your gold mine.
That's right.
Carl Esprey, CEO of Contango Holdings. Thank you very much and Merry Christmas.
Merry Christmas to you guys as well. Thank you.
Yeah, Merry Christmas to you, Carl.
This podcast was brought to you by Roast PR Limited. If you would like to appear on a future episode of The Sunday Roast, please email admin@thesundayroast.net.